Not all dividend stocks are what they seem. Some look safe until they explode in your portfolio, slashing payouts, tanking in value, and leaving your income plan in ruins. In this video, we're revealing 5 of the most dangerous dividend traps investors fall into. You'll learn how to spot red flags before it's too late, avoid high-yield mirages, and protect your portfolio from income killers hiding in plain sight. This isn't about chasing numbers. It's about defending your future. Because when you're building lasting income, one bad dividend pick can set you back years. Part 1. Declining cash flows and earnings. You see a company paying solid dividends year after year. Everything looks stable. But then, bam! The dividend gets slashed in half. Stock tanks. Investors panic. What just happened? Welcome to trap number 1. Declining cash flows and earnings. Dividends do not come from thin air. They are powered by cold, hard cash. If a company's earnings drop and cash flow dries up, that dividend is hanging by a thread, even if it still looks fine on the surface. Let me show you how this silent killer works. Take General Electric. For decades, it was a dividend darling. Reliable, trusted. Then, in 2017, the company's free cash flow cratered. Boom! Dividend cut. Stock hammered. Investors blindsided. Then there is Tupperware. Sounds stable, right? But when their free cash flow dropped 60% in 1 year, they had no choice but to slash their dividend by 60%. The market reacted brutally. Another trap sprung. And in 2025, Xerox cut its dividend in half. Not because it wanted to, but because it had to. Revenues were falling. The core business was shrinking. And the cash just was not there anymore. This is what makes declining cash flows so dangerous. They do not shout. They whisper, quietly eroding a company's ability to pay, until one day it all breaks. And this trap hides in plain sight, especially in sunset industries. Legacy businesses that are past their prime. Revenues slowly drip away, margins thin out. But the dividend? Still glowing, still pulling people in, until it snaps. So here is your move. Dig deeper. Do not just look at the dividend yield. Check the company's earnings trend, free cash flow, revenue growth. Because if the core business is dying, the dividend will not survive for long. Part 2. Unsustainable payout ratios. Imagine a company giving out more money than it actually makes. Sounds insane, right? But that is exactly what happens when a dividend payout ratio goes above 100%. Trap number 2 is dangerous because it feels generous. The company is handing out big dividends. Investors are thrilled. But behind the scenes, the math does not work. You are getting paid with money the company does not have. Let's break this down. The payout ratio tells you how much of a company's profit is going to dividends. If it is 60 or 70%, fine. That leaves room for reinvestment and a cushion for bad years. But if it is 100% or more, that is not a payout. That is a warning. In early 2025, Portman Ridge Finance found itself in trouble. Its investment income was sliding, and its payout ratio went off the charts, well over 100%. Result? A brutal 32% dividend cut. Investors who ignored the payout ratio? Burned. Same month, different story, same trap. Crown Castle slashed its dividend by 32%. Not because business was collapsing, but because the dividend had become completely unsustainable. The payout ratio was about to spike over 100%. The company had no choice. And then came AFC Gamma. It cut its dividend by 30% after its payout ratio ballooned. Rising credit risk, rising costs, and the same ending. An unsustainable payout and a stock drop of over 20%. What do all these companies have in common? They ignored the warning signs, or worse, they masked them. This trap is especially common in sectors like energy and telecom. When earnings dip, they keep paying high dividends to keep investors hooked. But the longer they fake it, the harder they fall. So here is the rule. If the payout ratio is above 100%, run. That dividend is not income. It is borrowed time. Part 3. High debt levels fueling dividends. What if I told you some companies keep their dividends alive by going deeper into debt? This is trap number 3, using borrowed money to pay shareholders. It sounds crazy, but it happens more often than you think. And when it blows up, it is ugly. Here is how the trap works. A company hits tough times. Earnings fall. Cash dries up. But they do not want to scare investors. So instead of cutting the dividend, they take out loans, issue bonds, pile on the debt, and it works until it doesn't. Take Frontier Communications. The company had sky-high dividend yields and mountains of debt. Investors were thrilled until the day it filed for bankruptcy. Years of borrowing to keep dividends flowing finally caught up. Shareholders? Wiped out. Or look at Thames Water in the UK. They racked up billions in debt while paying out massive dividends, all while skipping on infrastructure upgrades. Now, financial chaos. Politicians furious. Public trust broken. Debt-fueled dividends are a house of cards. Interest payments rise, credit ratings fall, financial flexibility disappears, and eventually, the whole system cracks. So how can you spot this trap? Start with the debt-to-equity ratio. If it is climbing fast, ask why. Check the company's free cash flow. If it is negative but dividends are still flowing, that is a red flag. And watch credit ratings. Downgrades are the canary in the coal mine. Debt should be used to grow a business, not to fake financial strength. If dividends are coming from borrowed money, you are not getting income. You are getting risk. Part 4. Eroding competitive advantage. What if the company you trust is quietly losing the very thing that made it great? This is trap number 4. The dividend that stays strong, while the business falls apart underneath. It is the trap of eroding competitive advantage. Some companies do not cut dividends right away. They keep paying, just like before. But behind that consistent payout, they are losing market share, getting outpaced, falling behind. The business is bleeding, but the dividend covers the smell. Take Intel, once the king of chips. But by August 2024, they were in crisis mode, cutting 15% of their workforce and suspending their dividend. Why? Because competitors like Nvidia and AMD were racing ahead in AI. Intel stopped innovating fast enough. They lost their edge. And the dividend? It vanished. Then there is VF Corporation. Big names like Vans and the North Face. But in October 2023, boom, a 70% dividend cut. The reason? Cash flows crashed. Vans, their star brand, was no longer cool. The market moved on. VF didn't. And look at Bloomin' Brands, parent of Outback Steakhouse, cut their dividend by 37.5% in 2025. The reason? Brutal competition, rising costs, and shrinking sales. The moat was gone. This trap is subtle. It sneaks in. You see the same dividend, quarter after quarter, but you miss the falling margins, the slumping innovation budget, the quiet market losses, until the cut hits, and it is too late. So how do you avoid it? Track competitive positioning. Follow industry trends. Is the company leading or lagging? Are they investing in the future or coasting on the past? Part 5. How to spot and avoid dividend traps. Now that you know the traps, here is how to dodge them. You want dividends that are safe, steady, and built to last, not time bombs hiding in plain sight. So how do you tell the difference? It starts with the numbers. First, the payout ratio. If a company is paying out more than 70% of its earnings as dividends, that is a red flag. Over 90%, that is danger territory. It means there is no margin for error. Any drop in earnings could trigger a cut. Next, check the debt-to-equity ratio. You want it under 1.5. Higher than that? The company may be borrowing to keep dividends flowing. That is not sustainable. Then, there is free cash flow. This is the money left over after a company reinvests in itself. If that number is negative, but the dividend keeps coming, you are probably being paid with debt or desperation. Do not forget earnings stability. Are profits consistent, growing, or swinging wildly quarter to quarter? Volatile earnings make for vulnerable dividends. And finally, the moat. Does this company have a real competitive edge? Is it a leader in its space? Or is it slowly being outpaced, disrupted, or ignored? If you are not checking these boxes, you are investing blind. Luckily, there are tools that do the heavy lifting for you. Yahoo Finance gives you the basics. TKR Terminal dives deep into financials. Morningstar shows you dividend history and analyst ratings. And a tool called Simply Safe Dividends even gives a safety score, so you can see the red flags before they explode. If you've made it this far, I've got a free bonus that could save your portfolio. It's my Dividend Landmine Detection Guide, a checklist of 5 traps to avoid, how to spot red flags early, and a printable cheat sheet you can use before buying any dividend stock. Just comment Landmine on this video. Once we hit 50 comments, I'll drop the link for everyone to download. Now that you know the dividend traps to avoid, it's time to take action and start growing your income the smart way. In the next video, I'll show you exactly how to turn just $500 a month into $1,000 a month in dividends. No complicated tech stocks needed. Get ready to build real, reliable cash flow step by step. Don't miss it.